Ever wondered why the mortgage lending process is so complex? It's a maze of numbers, terms, and legal jargon, isn't it? Luckily, the TILA-RESPA Integrated Disclosures, or TID for short, is here to change that. Introduced to streamline and simplify the mortgage lending process, TID combines certain disclosure requirements of the Truth in Lending Act and the Real Estate Settlement Procedures Act. Its ultimate aim: to provide borrowers with clearer, more transparent information about their mortgage loans. So, let's delve deeper and understand what exactly is TID and why was it introduced. What led to the introduction of TID? The response, my friends, lies in two key facets: enhanced transparency and simplification of disclosures. In the days before TID, borrowers often found themselves navigating a labyrinth of complex mortgage terms and costs. The architects of TID envisioned a system where borrowers were armed with clear and concise information about their loans. But they didn't stop there. They also sought to simplify the loan disclosure process. How? By combining certain disclosure requirements of the Truth in Lending Act, also known as TILA, and the Real Estate Settlement Procedures Act, or RESPA. This simplification resulted in two main forms: the loan estimate and the closing disclosure. These documents are designed to provide borrowers with a clear understanding of the loan terms and costs, from application to closing. TID was introduced to make the process more borrower-friendly. But what are the rights of the borrowers under TID? What are the rights of borrowers under TID? Here, we delve into the key rights of applicants under TID, ensuring a fair and transparent loan process. Firstly, borrowers are entitled to accurate disclosures. This means they have the right to receive precise and timely information on loan terms, including the loan estimate and closing disclosure, which are essential in understanding the costs and terms of the loan. Secondly, borrowers have the right to review these disclosures. They are given the opportunity to scrutinize the loan estimate and closing disclosure prior to closing, ensuring the accuracy and clarity of the information. This review period is crucial for applicants to fully comprehend the terms, conditions, and costs associated with their mortgage loan. With these rights, borrowers are protected. They are given the power to understand, question, and confirm the specifics of their loan. But what about the lenders? What laws do they have to follow? What does TID mean for lenders? Well, the rules are pretty straightforward. Under the TID rule, lenders are obligated to provide two key documents to borrowers: the loan estimate and the closing disclosure. The loan estimate is a document that lenders need to provide within 3 business days after a borrower submits a loan application. It outlines the estimated terms and costs of the loan, giving borrowers a clear picture of what they can expect. The closing disclosure, on the other hand, is a document that lenders must provide at least 3 business days before the loan closing. This document details the final terms and costs of the loan, giving borrowers a final run-through of their mortgage details. These laws ensure that lenders provide borrowers with timely and accurate information, empowering them to make informed decisions when obtaining mortgage loans. These laws ensure that lenders provide timely and accurate information. But are there any exceptions to these rules? Are there any exceptions to providing these initial disclosures? Absolutely. And it's crucial to understand these exceptions to ensure transparency in the mortgage lending process. The first exception occurs when there's an incomplete loan application. According to the Truth in Lending Act, or TILA, a lender is not required to provide the initial loan estimate if they don't receive a complete loan application from the borrower. This emphasizes the importance of providing all necessary information when applying for a loan. The second exception comes into play if the borrower withdraws their loan application within 3 business days after receiving the loan estimate. In this case, the lender is not obligated to provide further disclosures. This underlines the borrower's right to reconsider and withdraw their application without any penalty. In summary, the TILA-RESPA Integrated Disclosures, or TID rule, primarily aims to simplify the mortgage lending process and provide borrowers with clear, concise information about their loans. It combines certain disclosure requirements of TILA and RESPA into 2 main forms: the loan estimate and the closing disclosure. It also establishes specific timelines for lenders to provide these disclosures to borrowers. These rights and regulations are in place to protect consumers, ensuring they receive accurate information about loan terms and costs. This empowers them to make informed decisions when obtaining mortgage loans. TID is indeed a powerful tool that empowers borrowers and makes the mortgage lending process more transparent and easier to navigate.